Hello and welcome back to All Things Money. I'm your host, David Blain. Thank you for joining us for this second segment of today's show. We have John Gjertsen here with us today. He's an advisor in our office, and he's got a lot of expertise in taxation and retirement plan contributions. So we asked him to come on today to talk a little bit about traditional and Roth IRAs. If you missed the first segment, head on over to our website, dlblain.com. And in about a week or so, we'll have an archived copy of the show, and you can kind of catch up on it. But this has been a great interview on who should contribute to a Roth IRA, who should contribute to a traditional, and which one is better. And so we'll continue on with maybe a summarizing question. But what would really steer someone to the decision towards contributing to a Roth IRA, John?
Right, like you said in the previous segment, if you're in a taxable situation where you have high income and you're in a high tax bracket in the present, and maybe you expect to retire and live in a state that doesn't have tax, or for various reasons you believe your tax rate in the future is going to be lower than it is now, then certainly the traditional IRA is going to offer you the greater benefit. And conversely, if you're in a situation where you maybe are unemployed for part of the year, or you have taken a pay cut somehow, and you expect to make more money in the future than you're making now, then the Roth IRA, if you're in a low tax bracket, does make a lot of sense. Really what you're doing here is you're trying to compare that which you ought to know, at least by April 15th, of what your tax bracket is, to what your marginal tax bracket's going to be 10, 20, 30 or more years into the future. And by the way, there's a tendency to completely overhaul the structure of the tax code every 5 or 10 years.
Right, so, that's right. We all know that.
But we do have some clues. We have a very fast-growing national debt, and we have at least one of the political parties that's looking at tax revenue as a primary way to address this. And we can look backwards and see that as early as recently as 1986, the top federal tax bracket was 50%, and in 1981 it was 70%. Right. So in light of this, I think you can look at where we are now and say that there's a pretty solid case that rates, especially for those that are better prepared, who plan well for their future, their tax rates are going to be higher.
One thing, too, that we've talked about in the office and that we recommend, just like with your portfolio being diversified, we have people invest in stocks and bonds and real estate and different asset classes. When it comes to retirement planning, a lot of times we'll take the same route as well and recommend, if you have, a big 401k at work, we like to see some money in Roth, and so you're diversifying by taxation. If you have a regular investment account that's taxed as you earn income and capital gains, which are preferential right now, if you have a Roth that is, in theory, going to be tax-free when you take it out, and then a traditional IRA where you get the current tax deduction. So sometimes diversifying by tax strategy is also a good idea, wouldn't you think, John?
Yeah, that's absolutely right, and for all the reasons you stated, as well as you're hedging against what the future is going to, what the future tax law is going to be. And then also, because this is all done at marginal rates, let me just describe to you 3 scenarios. Consider one extreme case where someone retires and for some reason they've made big conversions over time or whatever, but they have a huge Roth IRA. And that's really that's what their retirement is going to consist of, is Roth IRA distributions. And there's no pension income, and because the Roth IRA money comes out tax-free, Social Security, at least as it's presently taxed, would not be taxed at all.
That's right.
They're going to be in the 0% tax bracket, and they're going to either itemize or take a standard deduction or have an exemption that's going to be completely wasted in a sense, because they're not going to pay any tax in the first place. And so had they made the decision earlier in their career to have made a modest traditional IRA contribution, when they did pay tax, they could have had the benefit then, and they could have been able to take a modest distribution out of their IRA in retirement tax-free.
Right.
Okay, so that's why you don't want to put all your eggs in that basket. And consider another extreme, and I just want to read part of a letter to the editor in the Wall Street Journal, Monday, April 22nd. Someone says, I worked for almost 40 years. Every year I put away as much money as the law allowed. guess what? I now pay more in taxes than I did working. I was in the 22% tax bracket when I was working, but today, by the time the tax people finish with me, I'm in the 38% tax bracket. So it's clear this is actually a pretty realistic scenario. We see this from time to time with our clients where their money is all coming out of their IRA, and it's a big surprise to them that their Social Security is now taxed. 85% of that is now taxable. So it could have been more beneficial for them to make some Roth. And then, so the third scenario where you do approach retirement and try to sort of have some measure of balance and have, you know, a non-trivial amount of money in both an IRA and a traditional IRA, here's what you have the opportunity to do. You can actually set your income according to your goals and resources and what you can afford to take. So you set your income somewhere, but because you supplement that with, because part of that is comprised of your Roth distributions, which are tax-free, you can actually plan for and really make your AGI effectively whatever you want it to be. So you in order to qualify for some kind of a tax perk or to make the Social Security tax at a certain level, you know, with the complexity of, we talk about all the time that the rules are set up like it's a game and how unfortunate it is that it's so complicated. But I tell you what, for you and for me and for our clients, we're going to try and win that game. And having that balance allows you the opportunity to really do some effective tax planning in retirement.
That's right. Well, that's some great points, John. And just, you know, in summary, it is complicated, but with some planning, the idea is to sort of win this retirement plan game. Well, that brings us up to our second break, and when we come back, we'll probably continue with some new topics. So for All Things Money, I'm your host, David Blain.
Thank you.